In 2008, the world witnessed one of the most significant economic downturns since the Great Depression, the Great Recession. This catastrophic financial event not only devastated global markets, but also left a lasting impact on millions of lives. But what exactly were the forces at play that led to such a collapse? Today, we'll explore the hidden causes behind the Great Recession of 2008, unraveling the complex web of factors that converged to create a perfect storm. To understand the Great Recession, we must first examine the housing market and its pivotal role in the crisis. In the early 2000s, banks and lending institutions began to issue subprime mortgages, loans granted to individuals with poor credit histories. The reasoning was simple. With rising property values, even those who defaulted could be compensated by foreclosing and selling the house at a profit. This practice, driven by a relentless pursuit of profit, led to a housing bubble fueled by risky lending and speculative investment. The demand for these subprime loans was not just a domestic phenomenon, but was exacerbated by the global appetite for mortgage-backed securities. These financial instruments pooled together various mortgages, allowing investors to buy shares in what seemed like a solid, low-risk investment. Financial institutions across the globe, from Wall Street to European banks, eagerly acquired these securities, underestimating the risk involved and overestimating the sustainability of rising house prices. As housing prices continued to climb, so did the complexity of the financial products tied to them. The lack of regulation allowed investment banks to employ excessive leverage, amplifying the potential for profit and, crucially, for loss. Furthermore, credit rating agencies tasked with assessing the risk of these securities often provided overly optimistic ratings, lured by lucrative business relationships with the banks they were supposed to evaluate objectively. But the economy is a fragile ecosystem, and it didn't take much for this house of cards to begin crumbling. In late 2006 and early 2007, home prices began to stagnate and then decline. As a result, the subprime borrowers started defaulting on their loans, turning the tide against the previously insatiable market. Panic set in as financial institutions realized the securities they held, once considered safe, were, in reality, toxic assets. This realization triggered a domino effect throughout the financial sector, with banks unable to ascertain the extent of their losses due to the complex nature of their investments. The fear of insolvency led them to withhold loans, causing a catastrophic credit crunch. Businesses that depended on credit found themselves unable to operate effectively, leading to mass layoffs and a significant contraction in economic activity worldwide. Governments and central banks scrambled to respond, deploying a variety of monetary and fiscal policies in an attempt to stabilize the financial system. In the United States, the government launched the Troubled Asset Relief Program, or TARP, to purchase toxic assets and inject liquidity into the banking system. Meanwhile, the Federal Reserve reduced interest rates to near zero and launched quantitative easing measures, pumping money into the economy to encourage lending and investment. Despite these efforts, the economic contraction left a profound impact on ordinary citizens. Unemployment soared, housing foreclosures reached unprecedented levels, and countless families lost their savings and security. The recession also widened income inequality, as lower-income families bore the brunt of the crisis while executive bonuses at some financial institutions continued to rise. So, what lessons can we glean from the Great Recession of 2008? First and foremost, the crisis underscores the dangers of unchecked financial innovation and inadequate oversight. The rapid development of complex financial products, combined with insufficient regulation, created a highly volatile environment that was unsustainable in the long term. Furthermore, it highlights the interconnected nature of the global economy, where the repercussions of policies and financial practices in one country can reverberate across the globe. In retrospect, the Great Recession serves as a cautionary tale, a stark reminder of the importance of vigilance and accountability in the financial sector. It emphasizes the need for robust regulatory frameworks that can adapt to the evolving financial landscape, ensuring stability and protecting the welfare of individuals worldwide. As we conclude our exploration, we are reminded that while the Great Recession was a time of great despair, it also presented an opportunity for reform and reflection, urging us to learn from the past to build a more resilient future. In understanding the hidden causes of the crisis, we take a step closer to safeguarding our economies from such devastation in years to come.